Hello and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Ryshkova, your nonprofit auditor. I design nonprofit auditor points to help nonprofit community, its management, board members, and accountants and bookkeepers to help better understand what auditors do, understand standards, and hopefully provide some insight that will help nonprofit to have a good books and be in compliance with the law and regulations. Okay, today I want to talk about receivables, and specifically about accounts receivables and pledges receivables. What do we as the auditors do in how we test accounts receivable and pledges receivable when we perform audits? Why I think it's very useful for the board members, accountants, and bookkeepers and management, because when we're testing receivable, it's not we're testing for us auditors. That's what we're saying your nonprofit should have, regardless whether you have an audit or not. That's how receivables should be recorded, and that's what information you as a nonprofit should retain. Okay, let's talk about it. So first of all, every accounting software allows keep track of receivables based on aging. That report is generated in all accounting systems, and it's called Accounts Receivable Aging Report, where all receivables are lined up by aging, meaning the amounts are due within 1 to 30 days, 30 to 60 days, and above 90 days. So pretty much the older receivables and we'll say younger receivables. Amount of receivables on AR, we call AR, which is accounts receivable, in accounts receivable aging report have to agree to total receivables on the face of the financial statements. When we look at receivables, and you as a nonprofit, when you look at your aging receivables, you need to be able to see how old is your receivable and who owes, what party owes this receivable to your nonprofit. So it means that your receivables needs to be recorded not by what the receivables are for, but who is a donor or who is going to pay that receivable, right? For example, if you expecting to receive balances from the city of San Francisco, it needs to be customer name or donor name, city of San Francisco, because that report needs to show who is payee of these funds. Also, when we auditors and you as a management look at AR aging, your question should, if you look at the receivables that have been outstanding, meaning not collected for a long period of time, 90 days and longer, you need to understand why your nonprofit is not collecting these funds. What's happening? Maybe it's a long-term promise, meaning that multi-year promise, maybe donor gave you pledge for 3 years and you're expecting it collected in year 2, year 3. However, it might also indicate that the donor is not paying. And if the donor is not paying for whatever reason, you need to follow up. Maybe if the donor changed their mind or not planning to pay it, or you cannot find the payee, they're not responding to your requests, maybe this receivable needs to be written off, or allowance amount need to be recorded for this receivable. So accounts receivable aging report needs to be reviewed at least quarterly. I would say probably monthly, but if your nonprofit does not have sufficient time and typically do not have a lot of receivable, maybe at least quarterly, management need to take a look at the accounts receivable report and see what funder, member, supporter, who the balances, who owes money to nonprofit, and why these amounts have not been paid. So your nonprofit needs to understand what these amounts, because every time receivable is recorded, you also record revenue and receivable. accounting transactions is also debit receivable, credit revenue. So your revenue is increasing. So if your receivable is wrong, if there is amount is either not going to be collected or it was mistake, it means that your revenue is also incorrect. So they are tied together. So when you review your AR aging report, you're fixing your revenue in the same time. Another area where you need to pay attention on accounts receivable report, if you see any negative balances on the funder or donor. For example, if you have City of San Francisco and the total receivable is negative $5,000, that's indication that your receivable are not correct. You cannot have a negative receivable. Receivable, that amount of money that your nonprofit is expecting to receive in future, and if it's negative $5,000, it just simply does not make sense. It means that it's a mistake, and you as a management need to understand why you have a negative balance, and it needs to be fixed, either written off and corrected. So far we talked about 2 things that you need to do on an AR report. You need to obtain detailed AR report, which is easily generated from your accounting software. You need to see all the receivable and understand why they have not been collected, and you also see if there is any negative balances, and also you need to understand why they are, and if they simply wrong. If you see incorrect receivable, they're simply negative receivable, they're simply wrong. Also, one way you review your accounts receivable and see what is wrong on the receivable, incorrect, but you also need to understand what is not in receivable. Very often, if you know that your nonprofit is supported by billable grant, meaning that you need to perform the work, and then after the work is done, months is over, you need to bill the funder. So you also always know that you need to have at least 1 month of receivable on the books. So if you know that you have 10 billable grants a month, so you expecting to see receivable at the end of the year for at least those 10 grants for at least 1 month, right? So therefore, for example, you funded by regional center. Regional centers always paying nonprofits after the month is over. So if you funded by 2 regional centers, you know, for example, if your year end is June, at the end of June, June 30, you will have receivables for months of June on the AR report, because payments for those for June will come in July. Also, nonprofits needs to understand what is the difference between accounts receivable and pledges receivable. So accounts receivable, the money typically already earned, and nonprofit already has a right to these amounts to be collected right now. So that's going to be billable grant, where you already performed the work and you're applying for reimbursement, or it's a service contract where you performed the service exchange transaction and now you need to be paid. Those are current because they are due now. Pledges receivable are promises, and they are promised to organization by donors, and some promises could be multi-year promise. They can be promised, I'm promising right now, but I'm going to pay next year. So those receivable, pledges receivable, could be long-term. If I am making long-term multiple year pledge, 50,000 each year. So I promise right now 250,000, but this year I'm going to pay 50, another 200,000 will be paid in a year 2, 3, 4, 5. So those are long-term pledges receivable. So typically, if your nonprofit have a promises receivable, pledges receivable, they could be short-term or long-term, and that also needs to be presented on the financial statement separately. Why? Because as a management and as a board, you want to know if you see receivable, when they're going to be collected. if you see $200,000 in a receivable and you're saying, great, we have this $200,000 we're going to receive soon, but without knowing that they are multi-year, they're going to be in a year 2, 3, or 4, actually they're not going to be collected in the next year, maybe your understanding of financials would be different because you will not have access to these funds next year, right? So your liquidity of your nonprofit will be affected. Therefore, you need to be careful if your nonprofit has long-term pledges receivable. They need to be split up separately so the management and the board can understand the liquidity and can understand how much money will be available in the next 12 months. So long-term receivable will not be available. So also it's very tricky with the receivables how they need to be recognized as receivable, because it's also applicable to revenue standards. Either it's a donation or it's earned revenue. In any regard, receivables we consider as auditors a risky area because receivables always ties to revenue, and as an auditor, we do believe that nonprofits also needs to be paid very careful attention to your receivables, especially in order to do that. You need to not just look at the balance on the books, you need to look at your accounts receivable aging report, understand what balance is outstanding, what they are, what is probability that they will be collected, when they will be collected, and if you do believe there are some long-term receivables that need to be recorded separately, because those receivables will not be converted to cash within 12 months, so they really do not provide any liquidity for operational cash to your organization within the next 12 months. They need to be kept separately and probably will need to be followed with a funder separately. Long-term receivables represent specific risks of collection, right? The longer receivables, less collectability might be depending on availability of the funds and overall condition of the donor. And as auditors, what we do, the best testing for us, if it's a good receivable at the end of the year, if that receivable has been collected after the year end, or we can also confirm with the donor that their intent is still is to donate, and we confirming that receivable is still good at the end of the year. Thank you so much. Thank you for listening to testing of receivables, and I'm looking forward to see you for our next snap, where we continue our series of testing various accounts. Thank you so much, and looking forward to see you soon. Be safe.